Hello everyone, I hope you guys are doing well and studies are going in full swing. Now in today's video, we are going to discuss about the all important CA Final Financial Reporting RTP for September 25. Now in this RTP, like every other RTP in the new course, there are 10 case study based MCQ questions which I believe are quite manageable, and then 10 descriptive questions. Out of these 10 questions, the first thing that you would be searching, are there any new questions or difficult ones? Well, fortunately or unfortunately, yes, there are 5 questions which have quite a different application and understanding. So I would strongly recommend that at least you do these 5 questions. So this is 12, 15, 16, 19 and 20. And we will be discussing these questions at the beginning of our video and then take up the other questions which we will quickly discuss. So we'll first focus on solving these 5 questions in detail and then go on into the other questions. Now again, in this RTP, what I would recommend is, while you are watching this video, whichever are the questions, at least the new ones that we are doing, at least try to read the question. I'm not saying that you solve this on your own. Read the question so that you kind of have a background, and then jump into the video for that particular question will help you in a better understanding. So over here, I would recommend you to pause the video and read the question. Okay, if you have done that, great. Otherwise, let's get started. Over here, it's quite a big question, so we'll see what is asked first. You're asked to calculate the gain or loss on effective disposal of B. So there seems to be a disposal, and goodwill on acquisition of C. So there are 2 specific things that are asked. Now before we jump on into the question, in this RTP there are at least 3 or 4 questions which involve stake sale in consolidation, and hence I would strongly recommend that in your consolidation you prepare that stake sale part properly. 3 questions out of the 10 descriptive ones is a fairly strong focus on that, and hence do the stake sale in consolidation as well as in associates properly. It is highly likely it will come in the September 25 or in the Jan 26 papers. Okay. Further, you have been told that C is not required to prepare consolidated financial statements and ignore the possibility of transaction being classified as a reverse acquisition of C by B. So they are saying to reverse acquisition. Thank you very much by the institute to not consider reverse acquisition, but nevertheless, if we want to kind of review the question, let us get started. So first of all, these 3 lines are quite important. They kind of explain you the structure of the question. What I've done is I've tried to do kind of a rough write-up of the question so that we kind of optimize on our time on this video. I know you are in your last lap of preparation, so I've done a basic write-up on my board note. I'll share that to you on the Telegram channel as well, and we'll kind of discuss it from there so that we can optimize the time. So A has a wholly owned subsidiary B, wholly owned meaning 100% stake in B. A sells subsidiary B to C, who is a listed entity, for shares in C. So what is happening is, A is having a wholly owned subsidiary. However, A is giving up its wholly owned subsidiary to a company C, which is a listed entity, and in return, well, A will not give its subsidiary free of cost, so A will charge some consideration. In return, A is taking the shares of C. So A is giving up its stake in B, and in return it is getting a shares in C. It could have gotten cash, it could have gotten anything. Here they're getting shares, and ends up owning 75% of C shares. Now this is what makes this question very interesting. So what you'll try to first figure out is, what is the position of this company before the acquisition. There is a company A which owns 100% in B, which means there is no other entity owning anything else in B. I have a 100% stake, 0% is held by the NCL. Now this transaction says that A will give up its business of B to a company C, and in return C gives shares of C to A. Now these shares constitute a 75% stake in C, and thereby I can say that A obtains control over C. So post the transaction, what is happening is, there is a company A there is a company A, just a second, let me just remove this for a second. There is a company A who is holding 75% stake in C, and because C has acquired 100% in B, then C controls B. Now when I look at this transaction, I will try to break this up into 2 events that are happening. First, A is acquiring 75% of B, and thereby I can say A is acquiring control over B, and hence there is a business combination. Thereby, A will take over 100% of the assets and liabilities of C. And because it has a 75% stake, it will create a 25% NCI. So over here, there would be an NCI showing 25% stake, let us say in C. Further, C holds 100% in B. Now the question is, who controls B? I will say that directly speaking, it is C who is controlling B. However, who controls C? Well, A controls C by virtue of the 75% stake, and hence B continues to be ultimately controlled by A only. So previous to this transaction, can I say all the assets and liabilities of B were getting consolidated with A? Yes, because pre the transaction 100% of B was getting consolidated with A. There was no NCI that was getting created. Now post this transaction, still A, like a chain holding, continues to control B. However, because it controls B, it will have 100% of the assets and liabilities of B. However, now it controls B through C. Now in C, I have a 75% stake, and hence 25% is held by someone else. So 75% of C's net assets are going to go to the NCI. 75% of even B's net assets will ultimately go to the NCI. Sir, how? Let's say B has a net assets of 100. It distributes the entire 100. It goes to C. C distributes 100. 25 of that goes to the NCI. 75 will go to A, and hence now when A consolidates B, because it still has control, A will still consolidate 100% of B's assets and liabilities. However, A will now create a 25% NCI which has a share in the net assets of B. So effectively, one can say that when I look at this transaction can be broken up into two parts over here. Okay, we have just mentioned about the control, that is pre the transaction B was controlled by A, post the transaction B was controlled by C. Pre the transaction, we don't know C was controlled by whom, but post the transaction, we can say with confidence it is controlled by A, and hence one can say that B continues to be ultimately controlled by A only. Perfect. Now, what we were saying is this entire event will be broken up into two transactions. Now, the institute does not tell you directly to do like this, but this is a better way to understand. So, the two transactions is, now one can hypothetically say that A falls in love with C. It wants to acquire C, but it does not have money. So how will I raise money? Like someone advises A that you have a company B, you dilute some stake. You don't give up the entire 100%. You dilute some stake, like government does disinvestment. It owns 100% in LIC. It sells some of it and raises money. So you dilute some stake in B. The money that you will get, hypothetically, you will use that money to acquire shares in C. So in a way, there are two transactions. Earlier, I was having 100% in B. Now, I'm still having control in B, but I'm now having effectively a 75% in share in the net assets, which means 25% stake of B is getting diluted. So transaction number one is, if I look at the transaction breakup, stake sale of B. Earlier, I had 100% stake in B, which legally I sold. However, I acquired 75% in A, and hence effectively I have sold only 25% of B. So over here, this transaction can be said as a sale of 25% interest in B. Now this 25% interest, I still have 75%, and hence I can still control B, and hence this is a transaction which is a stake sale, not resulting in loss of control. So there is no loss of control in B. Now if there is no loss of control, if I'm not wrong, in our material, this is question number 21 of consolidation. If there's a stake sale where there's no loss of control, this transaction is treated as creation of NCI, which means I would say that whatever are the net assets of B appearing in A's CFS, 25% of that will be attributable to NCI. Now comes another challenge. There can possibly be some goodwill because A controls B since a very long time. So there can possibly be a goodwill. Now, currently, I have 100% of assets and liabilities of B in A CFS. I also have the goodwill of B in A CFS. This is 100%. However, when I give up 25% stake, will I derecognize the net assets? No. I'll still have 100% of the net assets and give 25% share to NCI. Will I derecognize goodwill? Think and tell me. Goodwill, Think and tell me, this is deep concept. Goodwill is created as per Ind AS 103. It can be created when control is acquired and it will be derecognized when control is lost. Now control is not lost. I still have control, but I've given up 25% stake. Do I derecognize 25% of the goodwill? Answer is no. My goodwill will still continue to appear at the entire value. However, like out of net assets, 25% of this value will be attributable to NCI. Now even 25% of goodwill will be attributable to NCI. Sir, why? Because when I acquired B, I would have recorded some goodwill. That goodwill still appears because I still have 75% stake in C and thereby 75% interest in B. But I don't derecognize 25% of the goodwill. So I will say goodwill continues to be, let us say, at 100 rupees. 25 of that is attributable to NCI. This is a concept that you have to clearly remember, that when there is a stake sale which does not result in a loss of control, you create a new NCI. And when you create a new NCI, you create the new NCI at the net assets appearing in A's CFS plus the goodwill appearing in A's CFS. Uska 25% share will be attributable. Keep that in mind. It is a transaction which results in no loss of control. It's a creation of NCI. So you will credit the NCI and debit what is the consideration that you are getting. You might get consideration in the form of cash, you might get consideration in the form of shares. In whatever form you are getting consideration, you will debit it. And the balancing figure, remember, it's a owner to owner transaction. Over here, this is creation of NCI. NCI is a part of owners, and hence the gain or loss will go to other equity. It will not go to the P&L. If you remember the logic we discussed in partnership, when there's a retirement of partner or admission of a partner, and there's a gain or loss that is adjusted in the capital accounts of the partners only. You don't take it into the profit and loss of the partnership firm. You will not say that during the year I made a profit because one of the partner was admitted. No. If a partner was admitted and other partners are gaining, that will adjust the capital accounts of the partners. And hence a gain or loss will directly go into the other equity. It will not impact the statement of P&L. That is one transaction. I'm not going to the numbers. I'm just trying to explain you what is happening. Transaction number 1, that is you are diluting 25% stake in B. So you will create an NCI in B, and whatever is a gain or loss, you will record. That is sub point 1, what is asked in the question. Second, you are also acquiring control over C. So one can say that there is a control which is acquired in C, and if control, that is 75% stake, is acquired in C earlier, you did not have any control over C. You had control over B. You still have control over B. So it's just at 100k badle, now you are having 75, and hence 25% is NCI. But C, so you had nothing. Now A controls C, and if I'm acquiring control over C, then your favorite Ind AS 103 on business combination will apply, and hence you will take over the assets and liabilities of C at its fair values, not based on balance sheet value. Ind AS 103, because you're acquiring a 75% stake, 25% NCI will be created. And whatever you are paying will be treated as purchase consideration and a balancing figure of goodwill. So if you are able to make sense of this, largely I would say you will be able to make sense of the question. The second transaction over here, I would say, let me highlight it with a different color. Acquisition. This is not a good highlight. Let me say over here, acquisition of control over C. This will be covered by Ind AS 103. You are acquiring a 75% stake in C and thereby acquiring control. So your entire scheme of things will be broken up into two parts. As if you have diluted 25% in B. The money that you got, you use that to acquire C. Keep that at the back of your mind before you read the question. Okay, sir. So we have just completed 3 lines. No, these were the most tricky 3 lines. Once you do this, most of this other part in the question is just given to throw you off track. Most of the other data is not as relevant. Let us review this nevertheless. So over here, the net assets of B prior to disposal are 10 lakhs. Fair value of the same is 13 lakhs. Remember, you're not acquiring new control over B. So you don't need to take over B's net assets at fair value. Whatever is the value appearing in your books, you will continue at that, and hence 13 lakhs is not relevant. 10 lakhs is a relevant number. 13 lakhs is just given to throw you off track. In A's CFS, B's net assets must be shown at 10 lakhs. And goodwill previously capitalized but not impaired is around 6 lakhs. So whenever you would have acquired a stake in B, at that point a 6 lakh goodwill must have been recorded. Goodwill is not amortized, but it is tested for impairment. There is no impairment, and hence 6 lakhs of goodwill is still appearing. The carrying value of B Limited in A's books is 15 lakhs. This must be A's SFS. So it is possible that when I acquired a stake in B, I paid a purchase consideration of 15 lakhs. I don't know, maybe at that time B's net assets must have been 9 lakhs and hence there must be a 6 lakhs goodwill, just for your knowledge. However, now B's net assets are 10 lakhs, maybe there is a 1 lakh rupee profit, whatever it is. Now I know that B's net assets are 10 lakhs and goodwill of B is 6 lakhs. This must be appearing in A's CFS. Now I held 100% of B. As we discussed, I'm giving up 25% of B and hence I'm creating an NCI. This NCI will get a share in B's assets and liabilities. Currently in A's CFS, you'll have 10 lakhs pertaining to B. You also have 6 lakhs pertaining to B and hence 10 and 6, that is 16 lakhs into 25. That will be, I think, if I'm not wrong, 4 lakhs. I can say the new NCI that will be created will be 4 lakhs. So the new NCI that will be created will be 4 lakhs. Against this, I will get some consideration. I don't know kitna mila hai. We will see that. But the new NCI that is formed appears to be 4 lakhs. Okay, this is point 1. At the date A acquired B, B's profit and loss reserve was 4 lakhs and B has since made a 1 lakh rupee post acquisition profit. That is fine. The position prior to the transaction was as follows. You have the goodwill appearing in the CFS at 6 lakhs, that is given to us in any case. Investment in subsidiary, that is, so this is A's books, this is B's books, this was elimination, and then there is CFS. Investment of 15 lakhs gets eliminated, and net assets, as you can see today, B has 10 lakhs ka net assets which is getting consolidated into A's CFS. Share capital, B ka share capital gets eliminated, B's pre-acquisition reserves gets eliminated, post-acquisition it had around 1 lakh, I had a 100% stake, and instead 1 lakh got consolidated. That's fine. This is, even if this balance sheet was not given, I would say my question solution remains the same. Acha. So B ka kahani yahan pe khatam hota hai. So this is B. Then you go to C. Okay, so let me write down C over here with a different color pen. The net assets of C prior to the acquisition of B were 3,80,000. Okay. The fair value of the same is 5 lakhs. Now, am I acquiring control over C? The answer is yes. If I am acquiring control over C, that means I will take over assets and liabilities of C at what value? No, you tell me what value? Fair value. 103 applies and 103 says you will take over assets and liabilities at fair value. That is 5 lakhs. C then issued shares worth 17 lakh 50, which is the fair value of consideration given for acquisition of 100% of B. Again, read this properly. What is written over here? C issued. अरे क्या हो रहा है यार? C issued shares worth 17 lakh 50. So as a part of this transaction, C has issued shares worth 17 lakh 50. This transaction, C has issued its own shares. Probably these are worth 17 lakh 50. 17.5 lakhs. This is the total value of the shares. In return, A has given up 100% of the business of B. So maybe I can say that the total value of the business of B is 17 lakh 50. Now in its books, B might have a net assets of 10 lakhs. In its books, B might have goodwill appearing of 6 lakhs on totality. However, if someone wants to acquire 100% of B, they need to be paying me a total consideration of 17 lakh 50. So I can say that the fair value of B's overall business can be 17 lakh 50. Okay, keep that in mind. See, then issued shares worth 17 lakh 50. They've even given you a description. What is that? Which is the fair value of the consideration given for acquisition of 100% of B. So if anyone wants to acquire 100% of B, they have to pay me 17 lakh 50. By the way, they could have paid me in cash. They could have paid me through any form. Here, C is paying that consideration by giving shares. If someone wants to acquire 100% of B, they have to pay 17 lakh 50. C over here is acquiring apparently 100% of B, but because C is issuing its shares 75% to A only, effectively only 25% of B is getting diluted. 75% still continues to remain with A. Now this is where I want you to have a deeper understanding. Now if I look at this question in the exact same form which is there, it is a little confusing. So I would try to break this up into an alternative structure. I can say that rather than entering into this structure that you can see over here, alternatively, this is just for your understanding, alternatively, A could have said, well you know what, I need some money. Just ignore these numbers for the time being, I'll just remove them. A could have said, well, you know what, I need some money to acquire C. Well, that money I can raise by selling 25% in B. So if B totally is worth 17 lakh 50 into 25% if I do, you will get 4,37,500. Now if I were to go into an open market, I have not gone into the open market, but if I had to go into an open market, I would have said that okay, I'm diluting 25% of B, in which case I should be getting 17 lakh 50 into 25%, which comes to approximately 4,37,500. So the consideration that I will get on diluting 25% of B is actually 437,500. So this is over here. In the first case, I'm selling 25% of B. 100% of B is worth 17 lakh 50, but 25% effectively is what I'm diluting, should be worth 437,500, and hence when I create an NCI, NCI has to pay me something. What is NCI giving me? NCI is giving me some consideration, can be in the form of shares, can be in the form of cash. Here I'm probably getting a stake in C, I'm getting control over C, but I don't know what is the value, I don't know the PC that I'm paying to acquire C. But can I say that what I'm getting on selling 25% of B is exactly the same amount that I'm deploying to acquire control over C, because beyond this there's nothing else. I'm not paying any further cash or anything. I'm saying that okay, I will dilute 25% of B. Whatever consideration I will get, I will pump in to acquire control over C. So the two numbers that were missing over here is, I don't know how much I will get if I were to dilute 25% of B. Well, 100% of B is worth 17 lakh 50, so 25% of that will be 4,37,500, and hence I will get 4,37,500 on selling a 25% stake in B. However, if there was a separate transaction, what do I do? Well, I'm saying that I will use that money to acquire C. What money? Well, the money that I get on selling B, that is 437,500, and hence I say that I want to buy, let's say I was doing this with a blue color pen. So over here, I was going to buy 75% in C. But what is the consideration? I don't know. Well, 25% of B that is diluted is a consideration. So the money that I get from diluting B, 437,500, is the purchase consideration for C, PC. That is the proceed. PC equals to the proceeds. That is 437,500. This is the heart of the question. If you can crack this, I would say that you are halfway through into the question. The money that I will hypothetically get if I were to sell 25% of B is the exact money I'm deploying in C. It is like saying there were owners in C. Let's say hypothetically we call them as Mr. C. Mr. C wanted 25% stake in B. So Mr. C would have paid 437,500. Then A wanted a 75% stake in C Limited, which would have also costed 437,500. And hence these were the two missing amounts in the question. Okay, so this structure, that is A acquiring a 75% in B, 25% is with the NCI, A having a 75% in C. Alternatively, this is the same. I put an equal to sign as A having 75% in C and B having 100%, C having 100% in B. I'll again repeat. Over here, B's net assets 100% go to C, but if C were to distribute it, 25% of them will go to the NCI. C's net assets will also 25% go to the NCI and 75% will go to A. Effectively, it is like A diluting 25% of its share in B and receiving 437,500, and A putting that same 437,500 for a 75% in C. And we will pass journal entries considering these two transactions. Okay, so again, if you read this, the net assets of C prior to the acquisition of B were 3,80,000. That is in the books. Fair value of the same was 5 lakhs. I'll take over the assets and liabilities at fair value. C then issued shares worth 17,50,000, which is fair value of the consideration for acquisition of 100% of B. Okay. Now, if I were to just focus on this, इसके आगे बहुत सारा noise है. I would say you will see a lot of things over here, but I would say all of this is noise. If you just end over here, your question is done. We will read everything further and we will also understand the implications. But from a solving perspective, the question ends over here. I can say that, okay, I have to create an NCI. Two NCI. NCI of B. I'm sorry. I'm just operating from kind of a temporary setup. I've had a surgery recently and I cannot go to my studio or office. So your screen might wobble a little. I'm just doing from a temporary setup. So please bear with me for this video and maybe a couple of other videos that might be released. But from an understanding perspective, you should not have a problem. Just manage the shakiness. Shaky. So over here, you have, okay, coming back. So if I look at this case, we look at the first transaction. If I look at the transaction breakup, I have written it on my board note, but nevertheless, there is a sale of 25% in B. Now, this I said was no loss of control. And as a result, this is a creation of NCI transaction. So this is NCI getting created. This is NCI in B. At what value will the NCI be created? Well, 10 lakhs was the net assets of B. Over here, you can see 10 lakhs was the net assets of B. And 6 lakhs was the goodwill. Remember, this was appearing in A's CFS. 25% of this will be given to the NCI. So 10 plus 6 into 25% will come to, I think, 4 lakhs. So this is 4 lakhs. However, against this, what am I getting? I'm getting some consideration, not in cash, but probably I'm getting the business of C. Now I can give any name. I can give investment in C, or like you did in your CA Inter, you can give the name business purchase, temporary account. I'm getting a consideration in the form of business of C or a business purchase, whatever you say. Business purchase. Let me call this as business purchase. If you remember in your CA Inter amalgamation, you used to use these words. Institute has not done this. They have shown it directly, but for a better understanding, this will be helpful. Business purchase account debit. What is the consideration? Well, 4,37,500. We have just come to that conclusion that if 100% of B was 1750 and I'm diluting 25%, then the consideration that I should be getting is 4,37,500. And hence, there would be a balancing figure of how much? 37,500. This balancing figure will go to other equity. We can show this as a gain on creation of NCI and take this into other equity. You cannot take this into the statement of profit and loss account because this is an owner to owner transaction and this will be shown as a part of other equity. Can I say this is the first part? Compute the gain or loss on effective disposal of B. We will say 37,500. There are other smaller, faster ways to do this as well, but let us say 37,500 conceptually perfect. But this is transaction breakup ka first part. I'm selling 25% of B, but I'm also acquiring control over C. Now, if I'm acquiring control over C, I will take over the net assets of C. I will take them over at 5 lakhs. Sir, book value is 3,80,000. Okay, 103 will apply and 103 says you will take over assets and liabilities at fair value. That is 5 lakhs. But you have taken over 100%. Yes, that is correct because I have control. But then you will have to create an NCI. NCI will have 25% share in this 5 lakhs. And hence, 1,25,000. This is purely C's net assets. Remember, B के जो net assets है, उसका 25% I've already attributed 4 lakh का NCI. C के जो net assets है, उसका 25%, 1,25,000 will be, this is 5 lakh into 1,25,000. Assuming I'm solving using proportional net assets method, will be attributable to NCI. Now, the problem is if you want to calculate goodwill, you need to find a purchase consideration. Now, purchase consideration is what I'm getting on diluting 25% of B. I'm in a way implicitly investing in C. So if I'm getting 437,500 on a 25% stake dilution of B, and that is the exact amount I'm investing for acquisition of control over C, then to business purchase. Let us say to business purchase or investment or business, whatever you call this, would be 437,500. This is your PC. I'm paying 437,500 to acquire control over C. And hence, if there is a balancing figure, if I sit and calculate, the balancing figure over here would be 62,500. This would be taken as goodwill. One of the ways in which goodwill is calculated is PC plus NCI. PC plus NCI minus net assets. PC over here is 4,37,500. NCI is 1,25,000 and net assets taken over are 5 lakhs. Which means if I do this, you are going to get 62,500 and that's it. The question ends. Now when you see this entire question, it appears to be monstrous. However, to be honest, para 1, para 2 and para 3, only if these 3 were given, no balance sheet has been given, still your question solution would be the same. Yes, if they were asking you to prepare consolidated balance sheet, then a lot of data is given, but that is not asked. They've just asked you to calculate goodwill on acquisition of Z, which is 62,500. In my opinion, the question ends over here. Now the institute does not pass any entries. They do some working. So they do a working like comparing to find a gain or loss. They compare the consideration that I get on selling B, that is 437,500, with 25%, that is 4 lakhs, and hence 37,500 is a gain that goes into other equity. I mean, you can also pass an entry like this for acquisition of control. Either you can pass an entry like this or you can just show a working like this and get 62,500. Let's say if I do this in lakhs, 62,500, and that's about it. Okay, there's a lot of literature written behind, but by and large that should suffice. I'll read the other parts as well, but before that I'll just see the question that we have done. So over here we say that in the transaction breakup there's a stake sale resulting in 25% dilution, so no loss of control, creation of NCI. So business purchase account debit 437,500 to NCI, which is having 25% of both goodwill as well as net assets, 4 lakhs, and then there is other equity because it's an owner to owner transaction. This is entry number 1. Entry number 2, 75% stake acquired, net assets of C is 5 lakhs. Samne you will create an NCI of 1,25,000. PC was missing, so these two numbers were missing, and this was the problem. Number 1, business purchase, and this is the same amount that is deployed, 437,500, and the balancing figure comes in the form of goodwill. Okay, so over here these are the two entries. Institute, what it has done is it has passed a single combined entry. Now if I combine these two entries, can I say the business purchase and debit and business purchase credit will get cancelled? Now once this gets cancelled, everything else will be taken. So what is debited? Net assets of Z, debited by 5 lakhs. 5 lakhs. What is debited? Sir, goodwill 62,500. Perfect. यहाँ पे तो कोई debit है नहीं, 437,500 is cancelled. What is created? NCI of B 4 lakhs is created. NCI of C 1,25,000 is created, and 37,500. This is what ICAI has done. It has passed a single combined entry, but maybe this might be a little tricky for you. So we have given you two separate entries which ultimately result in the same ultimate conclusion. They have not even asked you to pass a journal entry. You want to find a gain or loss. Goodwill is 62,500, gain or loss is 37,500, and that's it. The question, or at least I would say the solution ends. So the question is still continuing. Yes, there's a lot of story. We'll spend a couple of minutes to academically complete the question at least. आगे देखते हैं. So what they have done is they have shown you a breakup being 6 lakhs. Again, if I read this, the net assets of C, prior to the acquisition is 3,80,000, fair value is 5 lakhs. C then issued 17,50,000 in the form of 6 lakhs nominal value and 11,50,000 securities premium. 6 lakhs plus 11,50,000 is 17,50,000. The balance sheet of the three companies directly after the issue of shares by C are as follows. Now in A's SFS, just for my knowledge, earlier I had this just for my knowledge. The question has ended. If you have less time, you just skip into the next question from the timestamps that you see below. But in A's balance sheet, there would be an investment in C. Sir, earlier there was an investment in B that will be in SFS derecognized. Why? Because I'm giving up investment in B. So investment in C account debit to investment in B. I'm giving that investment in SFS. investment in B was appearing at 15 lakhs. Now in SFS I'm getting consideration worth 17 lakh 50. कोई बोलेगा नहीं, I'm diluting this 25% in B. In SFS तो A and B are different. So if I'm giving up 100% of B, in return getting 75% of C, so I will say that 17 lakh 50 I'm getting, and I'm giving up investment in B which was at 15 lakhs, and hence 2 lakh 50 would be my gain. So in SFS of A, just for your knowledge, you will have you have 95 lakhs plus 2 lakh 50 का gain आएगा. 95 lakhs plus 2 lakh 50, 97 lakh 50. Investment appears at 17 lakh 50. Earlier ये जो 15 लाख दिख रहा था, this will move out. Now you'll have 17 lakh 50. Other than that, this 10 million continues to remain the same. This is A's balance sheet. In B's balance sheet, honestly, there'll be no real difference. It continues to remain exactly the same because B के books में B has not received any consideration, but in C's books it is going to issue shares worth 6 lakhs, share capital 11 lakh 50 securities premium. So 11 lakh 50 is the securities premium. 6 lakhs, अच्छा ये 8 lakhs दिख रहा है, maybe 2 lakhs was the earlier share capital plus 6, that has come to 8 lakhs. 3 lakh 80 was the book value of your assets, and then I'm acquiring business of B. I am acquiring in my SFS business of B, which is worth 17 lakh 50. I'm giving my own shares of 17 lakh 50 in return. It's like a barter. I'm acquiring a business of B of 17 lakh 50 and giving my shares worth 17 lakh 50. So, मेरे लिए 17 lakh 50 appears as investment, and you will have 1 lakh 3 lakh 80 as the other net assets. Remember, this is book values. You will take over in A's CFS at fair values, that is 5 lakhs, but यहाँ पे book value है. So that's about it. The parent A had interest in B that costed 15 lakhs and has in effect swapped, that is given up that for interest in C group. So I've given up 15 lakhs in my SFS and in return got 17 lakh 50 and hence a 2 lakh 50 gain. In its SFS, A states the investment in C at the fair value of the consideration, that is 17 lakh 50. That is perfect. The NCI is determined with reference to proportionate share of C's identifiable net assets. Okay. And that's about it. Okay, they've asked you to calculate gain or loss. Well, you do that. Now, just for academic completion again, I know you are out of time, but the question can come and they can ask you to prepare consolidated balance sheet as well. So if I had to prepare a consolidated balance sheet from this, what will I do? Well, if I were to prepare a CFS, I will take over the net assets. Net assets will include assets of A. Let's say this is 10 million. I mean, let me do this in million, 10 million plus net assets of B. This is 1 million, 10 lakhs plus 3 lakh 80, nahi, 5 lakhs. This is 0.5 million. So my net assets I think will be 11.5 million. इसके अलावा there would be goodwill. Now goodwill earlier was appearing at 6 lakhs, that is 0.6 million plus another 62,500. इसको million में क्या बोलेंगे? 62,500 divided by 10 lakhs. Sorry for this, 0.0625, and hence this is 6,62,500. So this is 0.6625. This will be your goodwill. That's about it. All the intercompany investments will be eliminated. Other than that, your equity share capital will only be the share capital of the parent. So the share capital of the parent, which is I think 2 million, will continue as it is. Is it 2 million? Yes, it is 2 million. Will continue as it is. There will be a retained earnings of 97 lakh 50. अभी इसमें थोड़ा प्लस माइनस हो सकता है. There will be some problems here to directly consolidate. C का कोई retained earnings नहीं आएगा. B का 1 lakh which was earlier consolidated. There would be an NCI. How much would be the NCI? 4 lakh plus I think 1 lakh 25,000. 4 and 1 lakh 25,000 will be I think 5 lakh 25,000. This is 0.525. There would be some balance in the retained earnings which is which will be there, and then there will be some balance in other equity as well, which is 37,500. They've given you just for a reference, they've given you the solution which includes the consolidated balance sheet as well. If I can just draw that up. Okay, so this is 97 lakh 50,000 plus B का जो है A का जो है, so this will be eliminated. यहाँ पे 4 lakh will be eliminated, 1,50,000 will be there. They've given you a working note for the consolidated earnings. 95 lakhs which was previously there, forget 97,50,000, 95 lakhs which was previously there for A. To that, post acquisition profits of B of 1 lakh which were there, which is added, and then gain on disposal recognized directly in, which is 37,500. That will come to 96 lakh 37,500. Other than that, all our numbers will tally. Goodwill of 6 lakh 62,500. Net assets of 11.5 million. Share capital is 2 million. This is the reserve working, and non-controlling interest of 5 lakh 25,000. They have not asked you the consolidated balance sheet. So should we prepare it? I don't think so. But if it comes in the main exam and they ask you to prepare consolidated balance sheet, this is how you go ahead and do the consolidated balance sheet. Perfect. So that kind of takes care of, I would say, the most complex question in your RTP, that is question number 12. It did take a lot of time, but I did not rush through it so that you understand it in complete detail. Okay, next you will have 13, which is more of a repeat question. 14, which is also more of a repeat question. If time permits, we'll do it later at the end. We'll just discuss this, and then you will go to question number 15. Now, this is a question which involves associates as well as share-based payments. Okay, so again with the routine, read this question entirely and then go. It's a small question, but still read this. I hope you have done the grind. Let us review this. Again, this is not Ind AS 28 alone. This is 28 plus 1021 share-based payments. Beta Limited, who is the investee, maybe this is like the target company in which the investment was made, has issued 2,000 equity shares which are outstanding at the reporting date. Great. So it has 2,000 shares outstanding. On this date, Beta issues 1,000 share options to its employees, which can be converted into 1,000 equity shares of Beta. So that is a conversion ratio of 1:1. One option will ultimately convert into 1 equity share. The grant date fair value of each of these options is 1 rupee, and the options will vest over 5 years, and all 1,000 options are expected to vest. So usually we take the number of employees who are expected to exercise. Over here we think all the options will vest, and hence 1,000 will be exercised, and hence if I want to find the total expense, I'll say 1,000 options, conversion ratio is 1:1 into rupees 1. So this is total 1,000 ka value. But what is a vesting period? Well, we don't really know. We will spread this on a straight line basis over the vesting period. Beta recognizes a share-based remuneration expense of, no, we have been told vesting period is 5 years. We'll vest over 5 years into 1/5, and hence your answer will be Beta will recognize 200 per annum. Sir, what is a journal entry? Employee benefit expense account debit to SBP reserve. It seems to be an equity settled plan because there is no option to settle in cash, and then CB account debit to SBP reserve. Open and shut case. Beta recognizes share-based remuneration expense of rupees 200 in its profit and loss, which is perfect, with an offsetting credit to equity. When I say equity, there will be SBP reserve, share-based payment reserve, SBP reserve, which will be a part of equity in the current year. Okay, so this is regarding Beta. Acha, we'll just scan through what is asked. Point number 1 says past journal entries in the books of Beta and Alpha for recording the share-based payment expense for the first year. Now, I don't know who Alpha is, but for the time being, for Beta, if I had to pass the journal entry, my entry would be EB account debit. Now, that is an expense. EB account debit, that will go to the PNL of around 200 rupees in the books of Beta, with a corresponding credit to SBP reserve. It is a part of other equity, which is also 200. Perfect. So this is in the books of Beta. We don't know about Alpha. So let us read further about Alpha, and this is where the question gets interesting. Alpha, who is the investor, holds 600 shares of Beta. Now, initially we had said Beta had how many shares? 2,000 shares. So Alpha's shareholding would be 600 out of 2,000, and hence Alpha owns a 30% stake in Beta. Now 30% gives Alpha a significant influence, and thereby we can say that Alpha has a significant influence of Beta, and Beta is an associate. And if it's an associate, Alpha will record investment in Beta using the equity method. Under the equity method, I will take over all the share of profits. I'll not take over assets and liabilities, but I'll take over the share of profits as well as losses. So if beta had no other profit, no other loss, it just had the 200 rupees ESOP cost, I would say out of that 200, which is an expense for beta, 30% would be alpha's share, and hence 30% of 200, I believe that is equal to 60 rupees. That will be an expense, that will be alpha's share of beta's expenses or losses as I guess maybe, and that will be debited in the books of alpha. Now if I debit that, something has to be created. This is what we need to think, what needs to be created. Usually we follow a method called as the equity method. Under the equity method, if the equity increases, if the equity of the associate, that is beta, increases, that increase can be due to profits, that increase can be due to revaluations, due to fair value reserve. If the equity of the associate increases, I will record my share of the equity separately. However, in this case, if I look at beta, what is happening? Well, EB, which will be debited, thereby beta's retained earnings will go down by 200 and beta's SBP reserve is going up by 200, and hence both of them are a part of equity. Can I say due to this, the equity of the associate does not increase? There would be no increase in equity of associate. Okay, so there is a 200 rupee cost, but samne for an associate there is an SBP reserve. Now the problem is, this SBP reserve ultimately after 5 years, when it is exercised, shares will be issued to the employees, not to Alpha Limited. It will be issued to the employees, and thereby Alpha's stake will get diluted. So when I'm looking at this transaction results in an expense which will ultimately dilute Alpha's share in the associate, and hence for Alpha, if I have to pass a journal entry, the question guides you everything, so there is spoon feeding, but we don't need spoon feeding. At least before the exam में कोई spoon feed करता है तो अच्छा, but before the exam, if I have to conceptually think, I would say, well, Alpha is there. For Alpha, if there is let us assume there is no other profit of beta, there is no other loss which is there for beta, it is just this 200 rupees, then 200 ka 30% will have to be recorded as an expense. This is P&L, this is share of associate expense या फिर loss as a case maybe. Account debit. Achha, by what will I debit it? By 60 rupees. Sir, how 60? Well, 200 was the expense. Let us say this ultimately results in a loss into 30%, that is my share will be 60. Now the problem is, what will I credit? Well, I can't credit a reserve etc, because ultimately I am not going to get anything. The employees are going to get, and that will reduce my investment, and as a result what I will credit is, this is an expense which will reduce the investment value. This is investment in beta which is reducing because of an expense that is being incurred. It is like saying that if I'm paying salaries to employees but samne I'm getting no income, then that salary results in a loss for the associate, and my investment will reduce because the associate is making a loss, and hence investment in beta will be credited by 60. Now the question spoon feeds you this. It tells you further, if you see, Alpha has significant influence over beta. यार ये हमको पता है, 30% stake is there. Alpha recognizes its share of remuneration expense in the profit and loss. What is its share of the remuneration expense? 200 into 30%, which is its share, that is equal to 60 rupees, which is perfect. As a part of income from equity accounted investees, whatever is the line item which is showing the profit and loss from associates, from that I'll reduce 60 rupees. It records the offsetting credit. This is what they tell you. But even if they did not tell you, you should be doing this. It records the offsetting credit as a reduction in investment in beta. Why is it a reduction in investment? Because this is an expense and there is no corresponding increase in the net worth or net assets. I can show a credit to the reserves if there's an increase in net assets or net worth. Here for beta, this transaction does not result in an increase in net assets or net worth. One can say that, well, the net assets or net worth remain the same. Yes, but for Alpha, this transaction will result in a dilution of its investment ultimately, and hence this transaction will ultimately reduce the value for Alpha. So I will debit the expense with the corresponding credit to the investment. Okay, so this is what is there. Now so point 1 is done. At the end of the vesting period, all options vest and are exercised. So no employees leave and all employees even exercise. So there's no lapsing. The exercise price is 3 rupees per option and the face value for every share is 1 rupee. Now point 1 is done. You are passing journal entries in the books of beta. I've done this in red, and in alpha I've started this and done this largely in green. For recording share-based payment expense for the first year. Why just for the first year? If you want to do it for all the 5 years, this will be the same entry in year 2, 3, 4 and 5, both in the books of alpha, both in the books of beta. Now second, pass journal entries for exercising of the options in the 5th year in the books of beta. Now I want to pass a journal entry for exercise. For exercise I will debit bank account debit. Beta will receive money. How much? Well, there were 1000 equity options into rupees 3, which is the exercise price, and hence 3000. SBP reserve will be debited. Now earlier I was crediting the SBP reserve by 200 in each of the years for 5 years, and this will become 1000. SBP reserve will be debited, for example, by 1000. 2 shares will be issued, equity share capital. Well, face value is 1 rupee, so 1000 into 1, that is 1 rupee, and 2 securities premium. This is a balancing figure. I think this is equal to 3000. So if I go to see, due to this transaction, is there a net increase in the net assets? Well, my assets increase by 3000. So my assets are increasing by 3000. And what about my liabilities? There is no change in the liability, but my net worth, equity, is increasing by 3000 plus 1000, that is 4000, minus 1000. So net, I can say my net assets or my net worth post this transaction is increasing by 3000. So this transaction you will pass the entry, but remember that net assets or equity, which is a net worth, after this transaction will go up by 3000. My bank balance is going up by 3000, and ultimately my share capital plus reserves are going up by 1 plus 3, that is 4000, minus SBP reserve of 1000, so net 3000. Perfect. Okay, so point 2 is also done. Now we go to the last, point 3. In the books of alpha, compute the loss on dilution. How is there a dilution actually? Loss of dilution of shares in beta. First of all, from year 1 to year 5, alpha's stake in beta was 30%, but at year 5 end, once employees exercise the options, beta's total share capital would have become 2000 plus 1000, that is 3000. Alpha still continues to have 600 only, so I will have 600 now out of, if I'm not wrong, 2000 plus 1000, and hence post this transaction I just have a 20% stake. Now 20% is just about giving me a significant influence. However, that results in a dilution of 10%. So my 30% stake which was there is getting diluted to 20%. However, post this transaction my stake gets diluted by 10%, agreed, but my net worth, net assets or equity of beta also increases by 3000. I don't know what the before transaction equity or net assets are, but after the transaction that increases by 3000. So yes, earlier I might be having 30% of, I don't know what the net assets are, let's say they were 11,000. We'll just read that only and pass the journal entries for the same. Beta has net assets, that is net worth, net assets equals to net worth, that is equity, totaling to 11,000 immediately before the shares are issued. Remember, this is net assets or net worth, that is asset minus liability or share capital plus reserves, worth 11,000 before these shares are issued. After these shares are issued, 11,000 will go up by 3,000, that is 11 plus 3 will come to 14,000. So earlier I in a way had a 30% share in beta which had a net assets of 11,000. Now I have a 20% share in beta whose net assets are, I think, 11 plus 3, that is equal to 14,000. So that the difference, if any, will result in a gain or loss. Now ideally things could have been Quite straightforward. Unfortunately, that is not as easy as it sounds. So over here, if I have done some write-up over here as well. So if I look at, okay, let me just remove the numbers. When I say remove the numbers, people will just first try to see what the numbers were there. If I try to remove the numbers over here, I will say debit what comes in, credit what goes out. In a way, I'm not getting any cash, I'm not getting any consideration. So bank or anything is not debited. However, I'm having a 20% stake in beta and I'm losing my 30% stake in beta. I can do a shortcut and directly pass a net credit of 10% only. Having said that, the longer method, this is what Institute has done, is crediting the 30% investment and bringing in the 20% investment. So when I credit the 30% investment, I will say that before the transaction, there was 11,000 of net assets. Uska mere paas 30% sa 11,000 into 30%, that comes to 3,300. This is where I would have ended. Usually students would do this and they will proceed further. 11,000, remember, is a net asset of beta. I have a 30% share and hence 11,000 into 30% will give me 3,300. However, I am also passing in each of the years in the books of alpha, if you remember, I'm passing this entry which is reducing my investment by 60 rupees in each of the year. Remember, in the books of beta, there is no change in the net assets or net worth because of this 200 ka debit, 200 ka credit. So if for 5 years beta did nothing, it recorded 200 rupees ka expense, thereby retained earnings fell by 200, it recorded a 200 rupees SBP reserve. Beta's net asset would remain 11,000 only, and I would have 11,000 into 30%, that is 3,300. However, separately I am saying that because this is not coming to me, it is going to the employees, this will result in a reduction of investment by 60 rupees in each of the years. And this is where students make a mistake. They say that, okay, I will credit the investment by 3,300. However, your investment would be credited actually by 11,000 into 30% minus 60 into 5. So 11,000 into 30% is perfect, 3,300. However, that investment would have been reduced in each of the years by 60 rupees for a period of 5 years, and hence that investment is now appearing, if I'm not wrong, at 3,000. So I'm removing investment of 3,000 and bringing in investment, new investment, which is 20%. 20% of what? Well, 20% of 11 plus 3, that is equal to 14,000, and hence I'll bring in new investment worth 11,000 plus 3,000 into 20%. So I'll bring in new investment worth 2,800. I will remove an investment which is worth 3,000 ultimately, and hence the 200 rupees difference is called as the loss on dilution. So if you want to clearly understand the loss on dilution will be 200. Sir, how 200? Well, before, had this exercise not happened, I would have shown my investment at 3,300. Later, minus 60 over each of the 5 years, it would have come down to 3,000. Now, because of the dilution, I still have 20% stake, not a 30% stake. So I remove the 3,000 and bring in 20% of my revised net assets or net worth, that is 2,800. And the difference, if any, is the loss which is arising on account of dilution. So this takes care over here. Past entries, beta is, this is a 200 rupees, which is loss on dilution, which is there in question number 15. Again, quite a different question from what you have done earlier. Mark it as important. Okay, next you go to financial instruments. We have not even started financial instruments here. We go to financial instruments, and Institute has again an important question, asked you a question regarding embedded derivative. If you remember, on embedded derivatives there are two questions. First is loan with the prepayment option, which when we did in class, there is, I think, question number 63 or so, or it is also there in the module. This is just one question which has never been asked, at least in the main exams. And second is loan with a foreign currency embedded item, which has been asked a couple of times recently in the main exams, MTPs, RTPs as well. Now, Institute has moved on to loan with a prepayment option. So it asked you first loan with foreign currency embedded derivatives. If you see the last 1 or 2 years in the RTPs and MTPs, they were asking, they even asked in the main exam. Now, probably they have asked you a slightly different question on loan with an embedded option. And I would strongly recommend you refer question number 63 or 62 if I'm not wrong of your material, or the one question which is there with loan with prepayment and option, along with question number 16 as well. These are the two questions. Now before we go into this question, again we will do the usual drill. You will pause the video, read this entire question, you don't need to solve it, and then resume back. Okay, so I hope you have gone through the question. And before we start reading the question, I'll just run you through the concepts which are there for loan with a prepayment option. Now, this is a section of embedded derivatives, and within embedded derivatives, we have been taught that if there is a host contract which is a financial liability, let's say a loan that you have taken. Remember, loan taken is a financial liability, loan given is a financial asset. So if there's a loan that we have taken which is a financial liability and it has a prepayment option, so there is an embedded, that is stitched in a built-in derivative, then we will separate the loan and the derivative if the economic characteristics are not closely related. Remember, if the economic characteristics are closely related, that is, they have a strong economic relationship, then there is no need for separation. Now, how will I know whether the economic characteristics are closely related or not? One of the ways to do this is to find the amortized cost of the loan without the prepayment option and compare it with the prepayment price. If the difference is approximately equal at each of the prepayment dates, then we will say that they are closely related. However, if the difference is not approximately equal even on one of those dates, then we will say that these are not closely related and a separation is required. Now, how will I figure out the range for approximately equal? Well, that depends on the management. However, from an institute perspective, we take a difference of 2% usually. If a separation is required, then I'll separate out the loan without the prepayment option, show it separately, do the accounting using amortized cost method. It's a financial liability at amortized cost, and the derivative, that is the prepayment option which is there with the borrower, that is issuer of the loan. The prepayment option which is there is a derivative, and that derivative is not settled in own equity, and hence it's a derivative financial asset which will be accounted for using FVTPL principles. So the thing that you have to remember over here is, with question number 1, whether a separation is needed or not. Typically a separation is needed if the economic characteristics are not closely related. Second, once a separation is done, then how do you account for the loan? Well, using amortized cost method. And how do you account for the derivative? Well, using FVTPL principles. Now, keeping that background into consideration, we will go over here. There's a slight difference between the question which was there in the study material, where a fair value of the derivative was not given. Here the fair value of the derivative is given, and hence there might be a bit of changes, but if you are able to recollect your financial instrument concepts properly, this should not really pose a problem. Chaliye, so let us read this question number 16. Again, an important question, especially institute's favorite financial instruments. Okay, so let's get started. ZX issues a fixed rate loan, issues a loan, like a issuer issues debentures. So that is a borrower. So ZX is a borrower, issues a fixed rate loan of rupees 5 lakhs. Okay, so this is your actual transaction price, 5 lakhs, and incurs issue cost of 20,000. Now let us say the question ends over here. If I've taken the loan, my entry is bank account debit 5 lakhs to loan 5 lakhs. However, there's an issue expense. Now if it is loan at amortized cost, issue expenses are deducted from the financial liability, and hence my entry would be loan account debit 20,000 to bank 20,000, and hence my loan will appear at net 4,80,000, resulting in an initial carrying value of 4,80,000. Okay, so even if this was not given, we would have taken 4,80,000. The loan carries an interest rate of 8% per annum. This 8% is a coupon rate, will typically be on the face value, which is 5 lakhs, and is repayable at par, that is 5 lakhs, at the end of year 10. So it's a 10-year loan. However, under the contract, ZX can call the loan at any time after year 4. So prepayment can happen anytime after year 4 by paying a fixed premium of 30,000. So instead of paying 5 lakhs, you will have to pay 5,30,000 if you want to prepay anywhere between year 4 all the way up to year 10. The fair value of the option. This was not given in the question which was there in your study material. The fair value of the option is 10,000 at inception. So typically if you revise question number 63 or the study material question for loan, there was a 100 crore loan and we did not have the fair value. So you found the value of the loan without the prepayment option, and the balancing figure was the value of the option. Here it is the other way around. You have the value of the option, and hence you can find the value of the loan without the prepayment option. In embedded derivatives, the guidance is that you will find the derivative value or the host contract, whichever is more reliable, and the other amount will be the balancing figure. That is a typical guidance. Okay, the effective interest rate amounts to 8.30213%. It will be different because there is a transaction cost as well. How is the embedded issuer only call feature accounted for by ZX, who is the issuer entity? So the question is, should you account for it separately or should you combine and do no separation? That is first thing. Second, explain the accounting of the loan when in years 1 and 2 there is no change in the interest rate since inception for the instrument of similar maturity and credit rating. The option's fair value due to time value at the end of year 2 though is 6,000. So initially the fair value was 10,000. The fair value is falling to 6,000. Now typically the prepayment option becomes valuable to the issuer who has taken the loan if the interest rates in the market fall. If the interest rates fall, I would say that I can let's say the rate was 8.3 whatever percent. Now the rate becomes 6, 5, 4. I would say that I will exercise the prepayment option and pay off this loan, and then if I don't have money, take a new loan at a lower rate. But if the rates of interest rise or if the rates of interest remain the same, the option will not really have a higher value, though because time passes there can be a change in the value. Whatever be the reason, the option's fair value is falling from 10,000 to let us say 6,000. Now at the end of year 3 the interest rates have fallen. Now this makes the loan prepayment option very lucrative, and the option's fair value has increased to 9,000. How it is calculated is beyond our scope, but we have been given the fair value which will help us in the derivative FVTPL accounting. Okay, so what do you have to do over here? Probably explain the accounting for years 1, 2 and 3, especially considering the changes in fair value. And third, at the end of year 4 the interest rates have fallen further, so the option becomes more and more valuable, and the option's fair value increases to 20,000, and the entity decides to repay the loan at the end of year 4. Remember, they can exercise the option only at the end of year 4 only. Perfect. So over here, if you review this question and if we want to solve for this, we will first have to see whether the loan and the embedded derivative have to be separated or not. Now here there are various prepayment dates all the way from year 4 up to year 10. You can prepay anytime, but when you prepay you will have to pay 30,000 extra. That is, you will have to pay 5,30,000. As compared to the amortized cost, we will do that table in some time, so you will see that directly. Amortized cost, you will initially start at around 4,80,000, 4,90,000 or something in that region, and hence slowly you will go into the loan value. Now 5,30,000 with around 4,80,000, 4,90,000 etc. seems to be quite a big difference, and as a result one can technically try to find the loan amortized cost balance at the end of year 4 and then compare it with 5,30,000. If at that point only the difference is more than 2%, we can say with conviction that they are not closely related and hence a separation is to be done. Now we don't know, so let us say that you assume a separation is to be done. Let us say if you assume a separation is to be done, so I think we'll have to solve this separately. Question number 16. We don't know whether it is to be separated or not. The institute has clearly commented over here that a separation should be done because it appears to be a difference. 5,30,000 as compared to whatever is the balance of the loan appears to be a difference and hence separation, but we want to objectively find whether a separation is to be done or not. So at year 0, if we say assuming separation, we will also find whether we need to do separation or not. But first, assuming separation, what is the money you are ultimately going to get? Sir, I'm going to get in my bank account at year 0, I'm going to get 4,80,000. Bank account debit 4,80,000. Now Is this purely due to the loan? Well, this loan has a loan had there been no prepayment option, but there's a prepayment option as well, and the prepayment option is valuable. Remember, when we typically do the working, if you remember the sum that you have done, the option value was not there, so you found the value of the loan had there been no prepayment option and found the balancing figure as the derivative value. But यहाँ पे the derivative fair value is given again for the option holder who has a chance to prepay. This is a derivative financial asset. It is not a liability, it is an asset because it gives you a chance to prepay if the market interest rate has fallen. You are the option holder. You have the choice whether you want to prepay or not, and hence this is a derivative financial asset. So this is a derivative financial asset, account debit. I believe this is 1000. This was a value initially. And so we have separated this, and this will be like a loan had there been without. I'm sorry, there was some buffering in the middle. So we were saying that there will be a loan without the prepayment option. Now what will be the value of this loan? Well, the value of this loan, if I just do it arithmetically, would be 4,90,000. Now a student would be a little confused. Well, why is it 4,90,000? Well, in a way it's a balancing figure. I'm getting 4,80,000 for the loan, that is 5 lakhs, minus the transaction cost. This is 20,000. So 4,80,000. However, as the holder of the option, it is my responsibility to pay a 10,000 premium. So I will pay, for example, a 10,000 premium, and hence the loan in total would be worth 4,90,000. Again, this is a point where most of the students will have a doubt. Let me just explain it in a slightly more simpler way. For example, let us say there was a loan and there was no transaction cost. If there was no transaction cost, tell me, how much would I get, sir? I would get 5 lakhs. But is this a loan with the prepayment option? Yes. Now prepayment option, remember, is favorable to the borrower, that is issuer of the loan, and it is adverse to the holder. So if I had a choice between two loans which were at 5 lakhs, one is a loan without the prepayment option, one is a loan with the prepayment option, and if I am the lender who is actually investing, a lender would say that why will I take the loan with the prepayment option? Because usually prepayment option, if it is there with the borrower will prepay money if the market interest rates fall, and hence I don't want a loan with the prepayment option. I will prefer a loan without a prepayment option. So if there were two loans at 5 lakhs, both had no prepayment options. I mean, one of them had no prepayment option, the other would have a prepayment option. As a lender, I would have given money to the loan where there was no prepayment option. But if as an issuer I want the prepayment option, I will have to coax the borrower, coax the lender. So I would say that, well, you know what, I'll give you some premium. So if this loan is 5 lakhs, you have to pay me 5 lakhs. Yes, I will pay you 10,000 worth of premium. And hence, ultimately, I can say that for a loan of 5,10,000, you give me only 5 lakhs. Otherwise, I will take 5,10,000 from you, and then I will pay you 10,000 rupees. Net, 5 lakh will come to me, and the value of the loan is actually 5,10,000. Okay, 5,10,000 ka loan hai. Now if I bring in the transaction cost, 5,10,000 minus 20,000 will come to 4,90,000. So the loan, had there been no prepayment option, because I am doing a separation, had there been no prepayment option, but there would be a transaction cost, then this loan, I would say, just for my understanding, without the prepayment option ke wajah se I am getting lesser cash. Had there been no prepayment option, I would have gotten 5,10,000, but there's a transaction cost, so this is 20,000, and hence 4,90,000. Now to be honest, I don't need to do any of this because a balancing figure approach will work, but understanding why this 4,90,000 is quite important. Okay, so this is year 0. You show a derivative financial asset, and if you show a loan without the prepayment option. Now you have to prepare an amortization table for the loan, at least for 4 years, because the prepayment option kicks in at the end of the 4th year to start with year 1, 2, 3, 4, 5 and so on. If you see the institute material, they've done this for all the 10 years. But if I start the opening balance of the loan, had there been no prepayment option, this would be 4,90,000. Effective interest rate, now this is a fairly long decimal, 8.30 क्या है ये, 8.30, 213%, 213%. This is your EIR. Every year there is a coupon. Face value is 5 lakhs. 5 lakhs into 8%, I believe this will be 40,000. There is no principal payment and hence there will be a closing balance. So you can do the calculation. 4,90,000 into 8.30, 213%. What is this? 4,90,000 into 8.30, 213%. Maybe this is 40,680 approximately, plus 4,90,000 minus 40,000, and this comes to 4,90,680. You do this working time and again. If I were to just take the liberty of doing of just referring the solution, because this is more calculative, you can keep on doing this same thing. Kidhar chale gaya? Question number 14, 15, 16. Okay. So over here, if I go to see 4,90,000, if I can do the first year correctly, 40,680, 4,90,680. The other years you can trust yourself that you will be able to do year 1, 2, 3, 4. So at the end of the fourth year, you are at 4,93,080. Now this is the first time you get a prepayment option. There will be other years as well. But if you decide to prepay now, the prepayment amount will be 5 lakh plus 30,000. That is 5,30,000. Now if I try to find the difference between 5,30,000 minus 4,93,080 divided by 4,93,000. So this is how much? Institute has not done this, but I would prefer if you do this just to show the percentage difference. This is 5,30,000 minus 4,93,080 upon 4,93,080. If this is around 36,920 divided by 4,93,080, in percentage is around 7.48, if I'm not wrong, 7.48%. Now this is not approximately equal. This, you cannot say that the prepayment amount and the amortized cost is approximately equal. This is not approximately equal. Remember, if it is not approximately equal on any one of the dates, you will have to do separation, and as a result separation is required. What Institute has done is, rather than explaining that, they've written this big paragraph. Now either you write this paragraph or you do an actual comparison and you show that explanation. I think that is on you. You can either show an explanation that we will need to do separation because the prepayment penalty, that is 5,30,000, does not appear to be approximately equal to the amortized cost of the loan from year 4 onwards, and as a result economic characteristics are not closely related, and hence you will do separation. If you do separation, your first entry will be cash account debit, derivative financial asset account debit to loan. This is 4,90,000, and if you want to pass entries for each of the years, there will be an effective interest at 40,680, then 40,737, 40,798 and 40,684, and there will be a coupon payment. So in each of the years, we'll try to do the entry for this, and then this will be the loan. The problem is you also have a derivative. Now the derivative at year 0 was, I think, 10,000. At year 2, I don't know year 1 ka balance, this has become 6,000. At year 3, this has become 9,000, and at year 4, this has become 20,000. This is given in the question. You can review that. Now, if I have to pass the journal entry, I've already recorded the 10,000 ka derivative financial asset. Now, when I go to year 2, my entry will be, let us say, fair value loss or loss on derivatives, fair value loss to a derivative financial asset or embedded derivative asset. This is 10 minus 6. This is equal to 4,000. So the derivative financial asset will come down to 6,000. Then you go to year 3, the value increases. So this will be a derivative financial asset account debit to, let us say, a fair value gain, which will go to the profit and loss account because derivative is at FVTPL. This is 9 minus 6, which is equal to 3,000. And then finally, in year 4, when you go to see, the derivative jumps up to 20,000. So this is 11,000 gain. So when I go to year 4, let us say, your entry would be derivative financial asset account debit. This is 20 minus 9. This is 11,000 to a fair value gain, which will be taken to the profit and loss account, which is also 11,000. Now the derivative comes at 20,000, and you have decided to exercise the prepayment option. If you have decided to exercise the prepayment option, the loan will be debited. Loan kitna hai sir? I started at 4,90,000, but now I'm at 4,93,080. So over here, this is 4,93,080. To bank. Ultimately, I will end up paying 5,30,000. However, what about the derivative financial asset? That is also exercised, and hence derivative financial asset will also be credited because it has a debit balance of 20,000. So this will be to derivative financial asset, and this will show me the loss. This is 530 plus 20 minus 493,080. This will be 56,920. Will go to the P&L because it is on settlement of a liability. 56,920. So over here, if you go to see, in each of the years you will pass the journal entries. They have explained the accounting effects. So they have said 4,000 will be the loss in the second year, then there will be a 3,000 gain in the third year, and then there will be an 11,000 increase. Embedded option or derivative financial asset account debit to profit and loss. And then this is the important entry where you are saying your loan account debit 4,93,000 to bank. I will pay 5,30,000. Derivative option will be also becoming 0, and loss on derecognition of the liability will be 56,920, which will be taken to the P&L because it is not an owner to owner transaction. So this kind of takes care of question number 16. We will see what is the required part and see if we have anything else to be done. How will the issuer only call feature accounted by the issuer? Well, this will be accounted for separately because economic characteristics are not closely related. Explain the accounting of the loan when in year 1 and 2. Well, there will be a 4,000 loss in year 1 and 2, which will go to the profit and loss account. There will be a 3,000 gain, which will be there in year 3, which will go in the profit and loss account. And then there will be another 11,000 gain, which will go in the profit and loss account. And if the entity says to repay the loan, another 56,920 ka loss aayega, and that's about it. So this kind of takes care of question number 16. Now 17 is quite similar to, I think, question 8 or so that you have done in your Ind AS 21 foreign exchange. We'll discuss it later, but first we will do the completely different problems. Question number 18 is also, I think, similar to question number 14 if I'm not wrong. In fact, question number 14 in your material is a much more complex question where there is stock as well. Here they have given the cash flow statement where there is no hidden adjustment of stock. So it's a simpler version of the question that you would have already done. If you have not done this separately, then we will discuss this later. But abhi ke liye, we will just jump to question number 19 first. This is on leases, a slightly different question, but I would say it is manageable that way. But it's a different question compared to anything that you would have seen. So 19, I would say, again important, and also 20, which is on share-based payment. So that will wrap up the 5 completely different questions, and then we'll discuss the other 5 questions, and then if time permits, the MCQ based case studies as well. So Wealth Limited has entered into, again, before you start, I would say again pause and read the question and then come back. ठीक है सर, हम तो अभी रीड नहीं करेंगे, आप ही पढ़ो. ठीक है. Wealth has entered into a lease agreement with a lessor for a period of 5 years. So Wealth seems to be a lessee, and the annual lease rentals are 8 lakhs for 5 years. 8 lakhs in each year is what you are going to pay. There's an option at the end of the said period that the lease can be owned by the lessee. So there is an ownership option. The other factors to be noted are a discount rate, very important, okay? Discount rate of 8%, an interest rate implicit in the lease of 10%. Now, for the lessee, what should you take? Well, the the rate taken for the lessee first is a lessor's IRR, also called as the interest rate implicit in the lease. And if that is not available, then the incremental borrowing rate. So if you have been given an interest rate implicit in the lease that is at 10%, we will take that. So over here, I believe that your entire working will be based on the interest rate implicit in the lease, which is 10%. We don't know discount rate guy, maybe the discount rate may be WACC, it may be something. We have to follow 116 principles, and as per 116 principles, you will first take lessor's IRR. If that is not available, lessee's incremental borrowing rate. Basically, the interest rate implicit in the lease should be taken. Discount rate can be anything, it can be WACC, we don't know what, and hence we will take in such a case 10%. I believe institute has also taken that. So this is one important area where you have to do a selection. If lesser IRR and lessee's incremental borrowing rate was given, you will first take lessor's IRR, and then if not available, lessee's incremental borrowing rate. Here you have been given an interest rate implicit in the lease, apparent in the lease, which is 10%, and then some discount rate which is just given to throw you off track. Okay, wealth is reasonably certain to exercise the option. Reasonably certain to exercise the option. In such a case, your lease payment will include the amount that is likely to be paid on the purchase option to purchase the leased asset at the end of the lease term, and 56 lakhs is the exercise price agreed in the lease term for purchasing of land. I don't know, land was not given earlier, it is given over here, so theek, at the end of the 5th year. So what is the amount that you have to pay? Sir, 56 lakhs. Therefore, the same has been considered in computing the present value of the lease liability. Should it be considered? Yes. Even if it was not given, if there's a purchase option which is reasonably likely to be exercised, you will consider that, and I think they've told you that it is considered. That is correct. At the end of year 3, however, wealth exercised the option to purchase a land at a value of 56 lakhs. Now, this option was actually there at the 5th year. However, maybe you exercised it in the 3rd year, and hence there may be, let us say, a remeasurement or a modification in the lease. So over here, there may be an adjustment pertaining to the purchase option being exercised. Whereas the market value on that date is 75 lakhs, it does not really matter what the market value is. So earlier, the lease terms mentioned that you had to, let us say, exercise at the end of the 5th year. Now you are exercising at the end of the 3rd year, and hence at this point you will have to recalculate your lease liability, compare it with the present value or the ledger balance which is appearing, and if there is any change, adjust it against ROU assets. So if there's a remeasurement or a modification, as a case may be, what will you do? You will compare the lease liability. Let us say the lease liability was, I don't know, we will do that calculation, but let us say the lease liability was 60 lakhs. However, now you have modified, you have remeasured and decided that we will pay 56 lakhs and that is the end. And hence the lease liability now will be readjusted to 56 lakhs. There will be a 4 lakh reduction of lease liability. So lease liability will be debited. Where will the second effect go? Always against ROU asset if you go back and check your 116 principles. For the revised discount rate, consider interest rate implicit in the lease only. So ideally you will calculate considering the revised discount rate which you are taking at 10% only. This is what the question is instructing you. Now you are required to calculate the lease liability and the right of use asset for the lease with the lessor. ROU is depreciated on a straight line basis. Now they've told you, in my opinion, this does not have full data, but we will do it the way the institute has done. There is some flaw over here in my limited understanding, but they've told you to depreciate ROU on a straight line basis. So we will do that. Ideally, if there's a purchase option and the purchase option is likely to be exercised, then the depreciation happens over the useful life. Now you don't have the entire useful life of the asset, but one can always argue that if this is land does not have land has an indefinite life, and hence there will be no depreciation / amortization. However, if they've told you to depreciate on a straight line basis and the only basis on which you can depreciate is a 5-year, beyond that you have nothing. Well, one can always, I'll again repeat, say that land hai, but land ka life to nahi diya. Haan sir, land ka life indefinite hota hai, and hence you should not depreciate because you are going to own this land ultimately. However, if the question has told you to depreciate on a straight line basis, institute has depreciated on a straight line basis over the 5-year lease period, we will also do that. Though technically, if there's a purchase option which is likely to be exercised, then you don't depreciate over the lease term, you depreciate over the useful life of the asset because the asset is going to be with you only. Okay. So over here, we will depreciate over 5 years, considering this sentence given as well as whatever MyBAP Institute has done. Provide the amounts reflecting in the balance sheet, profit and loss, and cash flow statement at the end of year 1. Okay. In the balance sheet, you will see the ROU asset and the lease liability. In the profit and loss, you'll probably see the interest expense as well as depreciation. And in the cash flow statement, you will see the lease payment. Because this is a payment on lease liability, this will be cash flow from financing. What are the accounting entries? If Wealth decides to purchase the leased property at the end of year 3. So you are also asked the entries at the end of year 3. So initially, what do you have to do? You have to find the lease liability and the ROU asset, which you can do by finding the present value. So over here, I think we will go to question number 19, if I'm not wrong. Yes, question number 19. So if I want to find at year 0, your lease liability, this will be the present value of lease payments. This is 8 lakhs into the present value annuity factor at the rate of 10% for a period of 5 years. Plus, should I also take the purchase price? Yes. Initially, there's a purchase option at the end of the 5th year, and I believe that this will be exercised. So this is 10% for the 5th year. Let us say this is 0.6209 if I'm taking 4 decimals, and this is 3.7908 or 07 as a case maybe. So if I do this working, this is 8 lakhs into 3.7908 and 56 lakhs into 0.6209. So this comes to around 65 lakh 9,680. 65 lakh 9,680. There may be some decimals here or there. Chutta maaf. So over here, there's no other initial direct cost or site restoration or anything, and hence your entry at year 0 will be ROU asset account debit to your lease liability, which will be at 65 lakh 9,680. Now question tells you that what will be shown at the end of year 1 in your cash flow balance sheet as well as P&L. So if I were to go to see, I'll not pass the journal entries. If I were to go to see what is going to happen with the ROU asset, it will start at 65 lakh 9,680. Now in line with the institute treatment, you want to depreciate it on a straight line basis over 5 years. In my limited understanding, over here it will be over the useful life, and if it is something like land, it has an indefinite useful life, but my opinion matters less. Institute's opinion matters more. So over here 1/5, and hence this is 13 lakh 1,936. This will be your depreciation, and thereby your asset will appear at around 52 lakh 7,774. This is your ROU asset. Then when I look at the lease liability, I'll prepare an amortization table. So there'll be year 1, your opening balance will be 65,09,680, on which there'll be an effective interest or a finance cost, which is, let us say, into, I think 10%. I don't need a calculator for that, but nevertheless 6,50,968, and then there will be a payment. Payment is around 8 lakhs. So this will be an 8 lakh payment, and hence your closing comes to, if I'm not wrong, 63 lakh 60,648. This will be your balance that you will show at the end of the first year. Now when I go to see the balance sheet, the amounts appearing in the balance sheet is 52 lakh for the ROU asset, 63 lakh for the lease liability. In the P&L, the amount shown for depreciation would be around 13 lakh 1,936. Amount shown in P&L for interest or finance cost will be 6,50,968, and there would be a lease payment which will be shown as cash flow from financing of around 8 lakhs. So this will be your first part. We will just verify it once. This will be your first part. Second, provides the amount reflected in the calculate lease liability with the ledger. Initially we did amounts reflected at year 1 we did, and what will be the accounting entries if Wealth decides to purchase the lease property at the end of year 3. Now for this, what you will have to do is you will have to do this working again for year 2 and year 3 and somehow find the lease liability balance at the end of year 3. So if this is 63 plus 10% minus 8 lakhs comes to 61 lakh 96,713 approx, plus 10% minus 8 lakhs, if I am not wrong, this is 60 lakhs 16,384. Okay, now when you go to year 3, this is a lease liability of 60 lakh 16,384, which is going to be settled because you have kind of remeasured, modified as a case, maybe to 56 lakhs. So your revised lease liability will be clearly 56 lakhs, because other than this you don't have to pay anything. So you'll have to remeasure the lease liability. So you'll say lease liability account debit. Sir, by how much will I debit this? Well, 60 lakh 16,384, which is appearing, which is now going down to 56 lakhs. So this will become, I believe, what, 4 lakh 16,384 to what? Well, ROU asset. To ROU asset, 4 lakh 16,384. Now, if I go to year 3, what will be my ROU balance? My ROU balance would have initially started at 65 lakh 9,680 minus each year you would have depreciated 13 lakh 1,936 into 3 years का depreciation गया होगा, and hence your ROU asset would be what? I believe 26 lakh 3,872. उसमें से I will further adjust 4,16,384 because of the above adjustment, and hence at year 3 your revised ROU asset balance would come to what? Your revised ROU asset balance will come to 21 lakh 87,488. In fact, you will have to now reclassify this from ROU to PP. So this will be an owned asset. So this will be PP account debit to ROU asset, which will appear at 21 lakh 87,488, I believe. So if we just quickly verify from the solutions over here on whether what is happening here, on whether this working has been correctly done, we are almost right at the end. Yes, here you go. So this is around 65 lakh 9,600. We had 680, that's fine. Then you did 52 lakh and something, this is correct. Lease liability around 63 lakh 60,000 and something, that is correct. 13 lakh and 6 lakh 50 and 8 lakhs in cash flow from financing. So if you review each of these numbers, 52 lakh 63 lakh 60,000, 6 lakh 50, 13 lakh 1,000, all of this is correct. Now when you go to the third year, so they've given you a lot of literature. If you just bypass all of that literature, we say that 60 lakh 16,000 minus 56 lakh, that is 4 lakh 16,000, which is the adjustment against the ROU asset. Your lease liability is debited, ROU asset is credited. Other than that, your PP account debit to ROU asset will be at 21 lakh 87,562. We're getting approximately the same answer only. And then lease liability account debit 56 lakhs to bank 56 lakhs. Going forward, there will only be a PPE. Beyond that, there is nothing else. Remember, the PPE will be at the amount that you have paid and which is remaining in your asset balance. So that, I believe, this is around 2187, which is, I think, approximately the same. Yes, 2187, and that takes care of question number 19. And then moving on into the last of these dreaded new questions would be question number 20, where it is the institute's ESOP question, but along with ESOP, there is a possible conversion of an equity settled plan into a cash settled plan. Remember, when there is an equity settled plan, you will debit employee benefit expense, credit SBP reserve, and that will be based on the fair value on the grant date. However, later, if the plan mechanics change and you decide to settle in cash, then your SBP reserve balance will be debited. SBP liability will be credited, but SBP liability gets credited at the fair values at each of the balance sheet date. It is becoming a cash settled plan, and if there's a difference, if any, that will be taken to the reserves directly, because this is like a buyback. SBP reserve, remember, is an equity item, and in your CA intermediate there was a chapter on buyback. If you decide to buy back an equity item and decide to ultimately pay cash, it is a buyback, and the gain or loss, if any, will go against the reserves. It will not go against the P&L. So when on the date when you convert a equity settled plan into a cash settled plan, the difference between the existing balance in the SBP reserve and the balance in SBP liability based on the fair value today, if you have paid it, it gets settled there and there. But if you have not yet paid it, the difference, if any, will be adjusted against reserves, because it is treated similar to a buyback of an equity item. And in CA intermediate, if you remember, whenever there was a buyback, you would debit the share capital, securities premium, and the premium on buyback would go against the reserves in a prescribed manner. This will, like a general reserve or a capital redemption, capital reserve, etc., whatever is permitted, securities premium, but it will not go. Capital reserve, I think, was not permitted. CRR was permitted for bonus, but it will go against the reserves because it is an equity item. That is the one thing that you remember, and if you are able to kind of latch on to that, other than that, in this question there is nothing very tricky. But because very few questions are there on conversion from an SBP equity settled plan to an SBP cash settled plan, this question warrants a discussion. So this is last of these different important questions. Question number 20. Max Limited, don't really worry. I mean, Institute has this habit to give you very new and nasty questions in RTP, but most of them don't really come up suddenly in the exam. Now these questions can come in the exam because we've seen it in the RTP ones. Don't really expect a lot of completely fresh questions like this in the exam, because it is very scary to see an RTP like this and then say, oh, I've studied so much and where am I? Don't really worry. Most of the times RTP Institute gives you such questions. In the exam questions you see the past track record. They don't suddenly come up, which they have not been there. So Max enters into a share-based payment arrangement with its employees on the following terms. Okay, each employee will receive 500 shares if they remain employed for a period of 5 years. So each employee will receive 500 shares. So this is a vesting period of around 5 years. It is expected that no employees are expected to leave during the 5-year period. So this will be for all the employees. The grant date fair value of the award, this is not per employee, this is of the award as a whole, 4,000 for all the employees. Fair value of the award is 4,000, and if I spread it over the vesting period, 4,000 into, let us say, 1/5 will come to probably 800 expense to be recorded in each of the years. If an employee leaves Max Limited after 5-year period, perfect, that is after vesting, but before the shares are listed, okay, the entity has an option. Who has the option? Entity, not the employee, has an option to purchase the shares for the fair value from the employee. Remember, this option rests with the entity, and hence the entity, if it wants, if the shares are not listed, see, when you study ESOPs, you usually say that the employee will get the shares, but what will the employee do with the shares? We say that the employee will sell it in the market, but it can sell it in the market if the shares are listed. If not, well, I'm stuck with unlisted shares. So this company says that after 5 years, if you have completed vesting period and when you are exercising, the shares are not listed, I may repurchase, and at my choice, I may give you cash. But if I say I don't want to give you cash, I say that no, you take shares, you will have to take shares. And hence, can I say that this clause does not result in any obligation on the employer to pay cash? Remember, when is it a liability? If there's an obligation on the employer. Here the employer says that if I want, I may pay cash. However, there is no obligation on the employer to pay cash. So I can say that there is no obligation. There is no obligation to pay cash on the employer, and hence the plan still continues to be an equity settled plan, and hence the accounting will still be routed through the SBP reserve only. Okay, on the grant date, Max expects to list in the next 3 to 5 years. If it is listing, then it will not repurchase. It will say to the employees ke dekho yaar tumhare paas hai, you can sell the shares in the market, I will give you shares only. So it expects to list in the next 3 to 5 years, and if it expects to list in the next 3 to 5 years, it does not appear that the entity will buy, because entity ne bola I will buy, I may, emphasize on the words may, entity is an option. I may buy if the shares are not listed after 5 years. Well, I'm expecting to list within 5 years, and hence I don't need to buy any of your shares, and hence the accounting will be done as if it is an SBP reserve case. This is the first share-based payment plan, and Max has no past practice or stated a policy of buying back shares from the employees. So there's no constructive obligation. I cannot say SBP liability constructive obligation. I have no past practice. Neither does Max expect that it will settle the awards in cash, and hence this is again saying that this is there is no liability, not contractual, not constructive. Okay, at the end of year 2, Max no longer expects to list, and the employees are informed of this fact. So what? Even if it does not expect to list, it does not necessarily mean that they will have to pay cash. So if the question ended over here, it is still an SBP reserve case. Max Limited announces that to its employees that if it is not listed after 5 years and the employees leave, Max will, emphasize the words will, repurchase the shares, which means it does not expect, it no longer expects to list, and it tells its employees now that if it has not listed, which is what is going to be the case, it will repurchase. And if it will repurchase, now I can say that this plan is moving from an equity settled plan to a cash settled plan. The fair value of the shares is 6,000 on this date. Earlier we never bothered because it was an SBP reserve case, and hence it does not really matter, but now it becomes a SAR case, and hence it does matter. At the end of year 3, the fair value of the liability has increased to around 9,000. So this will continue because now it becomes an SBP liability. So you'll have to take the fair value at each balance sheet date. Determine the accounting for years 1, 2 and 3. What would be the treatment? Okay, we'll just focus on point 1. Point 2 we will discuss later. So when we do this case, I would say for question number 20, in year 1, entirely I was assuming that this plan is equity settled. In year 2 also entirely I was assuming this plan will be equity settled, but at the end of year 2 I'm converting it from a equity settled plan to a cash settled plan. That is happening at the end of year 2. Till that point it is equity settled, in which case I will take the fair value, I believe this is 4,000 on the grant date, spread it over the vesting period 1 by 5, and hence 800 in the first year. Technically I'll do into 2 by 5 over here. This is 1600 less earlier recorded, 800 was earlier recorded, and hence if I had to do accounting for years 1 and 2, my entry will be EBE account debit, employee benefit expense, which will ultimately go to the profit and loss, to the SBP reserve, share based payment reserve. This is 800 in the first year, 800 also in the second year, and therefore I can say that at year 2 end the SBP reserve will appear at around 1600. SBP reserve will appear at around 1600. Okay, now SBP reserve is 1600. At year 2 end, the entity says that it is now not going to list, and it says that if I don't list, I will pay cash to you. I will. It's not that I have an option. I commit to you. Commitment दे दिया, फिर खुद का भी नहीं सुनना. So over here I give you a commitment that I will pay cash, and hence over here I will create an SBP liability. But when I create an SBP liability, that will be based on the fair value. Now at year 2 end, the fair value is 6,000, but I cannot recognize the entire 6,000 because only 2 out of the 5 years have been completed, and hence 6,000 into 2 by 5. If I go to see 6,000 into 2 divided by 5 will come to 2,400. Now what the institute has done is it has correctly created 2,200. In my opinion, there is an error over here. There is an SBP reserve which you can debit. Sir, by how much can I debit the SBP reserve? Well, I will debit the SBP reserve by 1,600 because my ledger has 1,600 only. And the remaining 800 I will adjust against reserves. maybe general reserve, maybe retained earnings, etc., because I will treat this transaction as similar to buyback. And if there is a transaction which is similar to buyback, the equity in your books is appearing at 1600, and now it becomes a liability which you have to pay 2400 based on today's environment. 800 that you extra pay. It is like equity shares which were there at 1600 and you are agreeing to pay 2400. The 800 premium that you pay, premium and buyback, will be adjusted against the reserves. Now this is what I believe should be the solution. However, ICAI, what it has done is it has debited the entire amount against the SBP reserve. Now if you have a doubt कि भाई 2400 तो SBP reserve में है ही नहीं, I am with you. Even I don't know how this 2400 came in the SBP reserve. But if the exact same question comes, what you will have to do is you will have to follow what the institute has done and debit the entire amount against the SBP reserve only. So this is the entry which I think has a bit of an error. Like in the earlier problem, that depreciation is a point where I think there was a problem. Over here, first entry is correct, second entry is also correct, but when I go to the third entry, student will ask share-based payment reserve account debit 2400. Where is 2400? There is only 1600. I agree. Remaining 800 will go against the reserves, but this is what the IC has done. The correct entry should be SBP reserve account debit 1600, reserves account debit, retained earnings general reserve, whatever you call, 800 to SBP liability. In substance, they have explained reclassification represents repurchase by Max on its own share, so no further expenses recorded in the P&L. Correct, so that 800 will go into the reserves directly. Okay, abhi आगे क्या है? Now next, accounting is asked for 3 years. Now in year 3, your liability is, I think, what was it, 9,000 or something? What was it? I think it was 9,000. Yes. So your SBP liability now in year 3, this becomes a cash plan. Now under the cash plan, the liability is 9,000 into 3 by 5. That is 9,000 into 3 divided by 5 comes to, I think, 5,400 less earlier recorded. Earlier tak apne, I think 2,400 was recorded in SBP liability minus 2,400, and hence I think 3,000 will be recorded. So when I go to the year 3, this will be EBE account debit, which will go to the profit and loss account to SBP liability. To SBP liability, this would be 3,000, and then in the 4th and the 5th year, again depending on the fair value, you will solve. But you have not been asked for year 4 and 5, and that is where you can rest your case. But that is point 1. Point 2 is still remaining. So if you review point number 2, where is this? Yes, point number 2. What would be the treatment of the awards if at the end of year 2, Max does not inform the employees that it will repurchase the shares after a 5-year period, which means I can say that this will continue as equity settled plan. And if it continues as equity settled plan in years 3, 4 and 5, you will still continue to recognize 800, 800, 800 only, and ultimately your SBP reserve will turn up to be 4,000 at the end of the 5th year. And the listing of the entity shares is still achievable, but at the end of year 6, Max has not yet listed. That is fine. You are still not committing that you had to repurchase, and hence it will be an equity settled plan only. And 2 of the employees leave. Max exercises its settlement choice and buys the leaving employee shares at fair value. Now when these 2 employees leave, Max at his own discretion has decided to pay based on the fair value. So your entry will be SBP reserve account debit to bank, and there would be a difference. The question is, what about the remaining employees? Will the remaining employees plan automatically become an SBP liability? The answer is no, not necessary. Remember, if these 2 employees sets up a past practice which results in a constructive obligation that for the remaining employees also you will pay cash only, then you can reclassify from SBP reserve to SBP liability if it creates a constructive obligation. Otherwise, you will continue to show it as an SBP reserve only because there is still no contractual / constructive obligation on you, and that is the explanation, if you see in theory, they have given at the end. And this is where your new questions in your RTP come to an end. Again, these 5 questions are good questions. I know it has taken quite a bit of time, but you would have listened to this at, let us say, a more than 1x speed, hopefully, and you would have understood most of the parts. So for the remaining questions in the RTP, don't really spend a lot of time. Even we are not going to spend a lot of time. I'll try to do this in the best time efficient manner, so that you kind of have a broad understanding on what the remaining questions are. I'm not going to sit and solve, because each of these questions would have been done by your material, no matter where you have done your coaching. These are all past ICI questions. Some of them are in the study material, some of them are in the RTPs, MTPs, but you will be able to kind of address the same. So just let me quickly discuss this in just a second. Over here, if I go to question number 17, over here there is a case where you have received advance in foreign currency for revenue. The appendix on Ind AS 21 says that revenue should be recorded usually at the rate on the date of the transaction. However, if advance is received in foreign currency, it's a non-monetary item, and hence you will take the advance at the rate on the date when the advance is received, and then later recognize the remaining revenue on the rate on the date when the remaining revenue arises. So over here there is a $10,000 contract over 2 years. So $5,000 of revenue in the first year, $5,000 in the revenue in the second year. This will be ideally recorded based on the rates prevailing in year 1 and year 2. However, out of this, $3,000 has been received in advance, and as a result, that $3,000 will be recorded in the first year on a FIFO basis at the rate on the date when the advance is received. So $3,000 will be converted at the rate on 1st of February, that is the rate of the advance, and the remaining $2,000 will be the rate on 31st March 2003. The remaining $5,000 will be as on the rate on 31st March 2004, assuming the revenue is recognized at the end of the year. So that's about it for question number 17. Similar to question number 8 of your foreign exchange section, if you have done. Question number 18 is similar to question number 14 of your cash flow statement. Over here, you have a case where the company purchased certain goods from Europe, then they sold those goods in the US dollar. The amount is still payable in payable to the trade payables, and the amount is collected from the trade receivables. So in your cash flow statement under the direct method, you will first try to find the net profit. That net profit will take the gain or loss on sale of goods plus whatever is the foreign exchange gain on the trade payables, on the trade receivables, as well as the loan. Remember, the loan is financing, and as a result, any foreign exchange gain, if any, has to be reversed. Even the trade payables, if the money is not yet collected, the gain is unrealized, that is non-cash, and hence that gain will be reversed. But for trade receivables, since the gain is realized, you don't really need to reverse the same, and hence you will find the net profit. To that, add back if there's a loss, deduct if there's a gain on loan, also on trade payables as an alternative presentation, which is also possible. But under one of these methods, you will reverse that, and then you will take the changes in working capital. Remember, the money that is collected from debtors is operating, and thereby you will find the changes in working capital, and you will find the cash flow. This is question number 18. A more complex question was there where there was some inventory as well. In this case, the entire amount is sold, and hence there is no separate inventory. Now there is question number 14. This is entirely similar, I think, to question number 8 or 9 of your inventory, the last question, and one of the very good questions where you are purchasing some cattle. Ultimately, you are going to either sell it or slaughter it, and hence they will ultimately be treated like inventory, where you will recognize revenue, etc. The only new thing over here would be that there is some 500 veterinary expenses. Remember, initially you recognize the cattle, that is a biological asset, at fair value less cost to sell. Now a veterinary expense, that is medical treatment expense, is not a cost to sell, and hence this veterinary expense will go to the profit and loss account. Other than that, this entire question is an exact replica of the question which is there in your material. Okay, then you have investments in associates and joint venture. Here you have to find the gain or loss on the sale of 60% stake in S for the purpose of SFS and CFS. In this case, it's a 60% stake. Earlier you had a 100% stake. So this is a case where there is loss of control. Question 12, the big question was there is no loss of control. Here there is a loss of control. So over here, what you will do is you will find a bank account debit by whatever is the sale proceeds. 2, you will credit the net assets, you will credit the goodwill as well, and you will bring in the investment. This investment can be brought in at the fair value if it is available, otherwise proportionate net assets value. So over here, the carrying value of the net assets is 6 lakhs, and there would be some goodwill, so you will credit the goodwill as well. So your entry will be bank account debit. investment account debit to net assets to goodwill, and gain or loss, if any, will go to the profit and loss account. Okay, so you have to find the gain or loss in the separate as well as consolidated financial statements. You would have done multiple sums, I think from question 22 all the way up to 27 or 28 in consolidation pertaining to this concept. A similar question they have asked you is question number 11. Just that in question number 11 is also a stake sale question. Past journal entries for sale of 60% stake on disposal. As I said, Institute has done a lot of stake sale questions, so you better do that properly. Compute the gain on the 40% retained investment. The new thing over here, I mean, it's not really new, but there's a 4 million credit in available for sale reserve. Available for sale reserve is like the fair value reserve, and 10 million credit in revaluation reserve relating to subsidiary B. Now this available for sale reserve, it's a fair value reserve, can be on debt instruments, in which case it is a reclassifiable OCI, or equity instruments, in which case it is a non-reclassifiable OCI. So when I dispose of my subsidiary, I lose all the assets and liabilities of the subsidiary, then I will also have to reclassify my share of the reserves into either retained earnings if it is non-reclassifiable like revaluation reserve, or into the statement of P&L if it is reclassifiable like your available for sale reserve, assuming it is on debt instruments. Otherwise, question number 11 is again same as a stake sale question. Now when you look at the case study based MCQs over here, this is one question which is on financial instruments. You can just try to review this, prepare amortization table, and most of the data should flow through very seamlessly. Now this is a question which is very similar to a joint operation question. I think this is question number 19 of our material. It is there in the study material as well as in one of the RTPs. The only problem over here is you are doing a joint construction of the property. Joint construction, so this will be a joint operation, not a joint venture. You are doing a joint construction, and that is why you will follow proportionate consolidation method. Now the construction has started on 1st April and it completed on 30th September. So over here the construction has taken 6 months, and hence the question is that is this asset a qualifying asset? Apparently no, because if it is taking 6 months and if nothing is given, we will say that this asset is not a qualifying asset because it is not taking a substantial period of time. However, remember the 12-month guidance is not mandatory. Now generally what we would do is we would assume that this is not a qualifying asset and hence borrowing cost is not capitalized. However, in the Institute RTP question, it came in November 18, as well as in this question, in the MCQs what they have done is they have capitalized the borrowing cost, assuming 6 months to be a substantial period of time. Now to be honest, this is a little unfair because unless they tell you that this is a qualifying asset, it is not a qualifying asset. But as unfortunate as it sounds, if this question comes either as a descriptive question or as an MCQ question in the Institute study material, in the RTP of November 18 as well as in the RTP of September 25, everywhere for such a question they have assumed it is a qualifying asset. तो भगवान का नाम देंगे, याद रखेंगे, and we will solve it as if it is a qualifying asset, and only then will you get your MCQs correct. Otherwise your MCQs over here are not given correctly. I think Institute, if it gives this in the exam, we should clearly mention that students should assume that this asset is qualifying and solve. Now there is another question. This is on property, plant and equipment. Largely this is PP. Where this is very similar to that big question that you have for property, plant and equipment, where you will add the material cost, remove the abnormal cost during the period of construction, take directly attributable expenses and find the cost, add the present value of site restoration expense, and if there's a component, like component can be a roof, component can be overall cost, depreciation will be done separately using the component method. Okay. Then this is on Index 37. There is a lawsuit which is going on, and you believe that there's a 25% chance you will win the lawsuit, 75% chance you will lose the lawsuit, and hence the appropriate treatment will be you will have to create a provision for the amount that you will have to pay on the lawsuit. So there will be a provision that you will have to create for I think 1.6 lakhs. There can be the most likely value or the expected value, because there is only two possibilities. Institute has solved this using the most likely value and said that the entire provision has to be created, not 75% of 1.6 lakhs. The entire 1.6 lakhs ka provision create karna chahiye, because it is a contingency which is probable. And here you have a cash flow statement that is to be prepared, where you have the net income plus or minus depending on whether it is a non-cash, non-operating, and you get the answer. Like depreciation you add back because it is non-cash, accounts receivable, if it is decreasing, opposite effect, that is add increase in inventory, subtract increase in accounts payable. Liability है तो direct effect add decrease in wages, liability direct effect. Tax charge, deferred tax liabilities, deferred tax items, remember, are non-cash in nature, and hence you will also add this back. Profit on sale of land you will subtract, and that is what will give you your cash flow from operations. So this is a brief discussion on the other parts. As you can see, most of them would be manageable. If you do have any queries on the same as well, put this in the comment section, and if possible, I'll try to clarify the same. So this kind of wraps up your September 25 RTP. If you need any other help or any other question in any other material which the institute has recently issued, and you want me to cover the same, please do write in the comment section. And if you do like the video, please do press the like button. It means a lot. I know it is just pressing a like, but students will actually know that the video is good enough if you kind of do that, and do subscribe to the channel and press the bell icon if you want further updates. Nevertheless, keep studying hard. Don't get scared with the RTP. As I discussed earlier as well, this is not something that is necessary, kind of a precursor to what will come in the exam. In the exam, historically, FR paper is generally based on what was earlier there, and if there is a new odd question as well, it is maximum one odd question which is there. In a bigger question, you can still manage that. So keep your confidence sky high, and I'm sure you're going to do exceptionally well. Okay, chalo, goodbye, good luck, and take care. I'll see you soon with other videos as well. Also, the selected section for the AFM RTP, we will discuss that, and that should be it. Okay, chalo, bye bye, good luck, and take care.